Happy Monday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Europe, Asia, and North America. My name is Tony. As you can see, I'm still traveling. I'm still filming in my hotel room. Please forgive the informality of this environment. Also, this episode contains this month's first sponsored feature. Regular viewers will know that I limit sponsored features to only 2 per month to make sure they're not too disruptive, but also to ensure that I can work with particularly interesting companies and I can be picky with those that I choose. In fact, I'm so impressed by today's sponsored feature that I can say that in the coming days, this week, I will be taking a position in the company to hold long. That is, I will be personally investing in it myself later this week. So more on that later, but for now, let's jump into the first development, which is in North America. The value of America's official gold holdings has surged past $1 trillion for the first time, a vivid sign of the precious metal's renewed allure amid mounting fiscal and financial strains. Gold prices continue to hit all new records almost daily, extending a 45% rally this year, driven by investor anxiety over trade wars, geopolitical tensions, fears of government funding crises across the West and beyond, as well as a general sense that the world has entered a new era of uncertainty. The United States, the world's largest holder of official gold reserves, now commands a stockpile worth over $1 trillion, dwarfing the $11 billion figure listed on the Treasury's books. That discrepancy stems from a 1973 law fixing gold's accounting value at $42.22 per ounce. The Treasury's 261.5 million ounces are stored primarily in Fort Knox, Kentucky, with additional deposits in West Point, Denver, and 80 feet below the Federal Reserve Bank of New York. Speculation flared earlier this year when Treasury Secretary Scott Bessent hinted that the government might mark to market its holdings, unlocking hundreds of billions in paper gains. Such a revaluation would inject nearly $990 billion into federal accounts, enough to cover half of the $1.97 trillion budget deficit recorded through August. However, Bessent later denied any such plan, noting that the move would have, quote, far-reaching implications, end quote, for liquidity, monetary stability, and the Fed's ongoing balance sheet unwind. US-based Bloomberg analysts point out that this gold rally has one additional factor: private investors. Exchange-traded fund enthusiasts, a driver of gold's meteoric rise over the past 2 decades, have added more than 100 tons in September, the most in more than 3 years, according to a Bloomberg tally. Goldman Sachs Inc. has predicted the metal will soar to nearly $5,000 an ounce if just 1% of privately held US Treasury holdings go into gold. Now, while the Treasury's theoretical gold windfall grows, the Federal Reserve's balance sheet continues to shrink. New data shows bank reserves, the cash deposits commercial banks hold with the Fed, fell for the 8th straight week, down by $20.1 billion to $2.98 trillion, the lowest level since January. The decline reflects the Treasury's heavy debt issuance since July to rebuild its cash balances after the debt ceiling deal. With the Fed's overnight reverse repo facility nearly depleted, the drain has increasingly hit bank reserves, especially among foreign lenders. The drawdown comes as the Fed presses ahead with quantitative tightening, QT, allowing bonds to roll off its balance sheet to shrink excess liquidity. Yet signs of stress are emerging. Fed Chair Jerome Powell maintains that reserves remain, quote, ample, end quote, but some officials, including Governor Christopher Waller, estimate that the lower bound may be around $2.7 trillion, uncomfortably close to current levels. The juxtaposition is striking. Gold's paper wealth has never been higher, while the real liquidity sustaining the banking system is ebbing. Revaluing the Treasury's gold could, in theory, ease fiscal pressures, but it would risk destabilizing the carefully managed monetary system the Fed is trying to normalize. For now, the US's gold surplus remains locked away in Fort Knox, even as the nation's cash cushions steadily erode. Next up, we move to Asia. The crypto race is intensifying in Asia. Singapore has surged ahead of Hong Kong in the race to anchor digital finance, launching a cryptocurrency pegged to its own dollar amid a global crypto resurgence. The SGD stablecoin, issued by payment infrastructure provider Streamex, began trading on Coinbase in recent days, giving the city-state a crucial edge as rival financial hubs vie to attract digital asset ventures. Unlike volatile cryptocurrencies such as Bitcoin and Ether, XSGD is tied 1-to-1 to the Singapore dollar, providing a stable means of exchange. With a market capitalization of 14.8 million Singapore dollars, the token has received approval from the Monetary Authority of Singapore, MAS, reinforcing the city-state's reputation for cautious yet forward-looking regulation. Quote, for global players evaluating Asia as a launch pad, a regulated local currency stablecoin enhances Singapore's appeal as a hub for both global capital markets and Asia's digital economy, end quote, StraitsX said. Coinbase Singapore's country director, Hassan Ahmed, called the launch a vital step in making the Singapore dollar stablecoin globally accessible, enabling instant conversions between crypto and the Singapore dollar for payments, travel, and everyday transactions. The debut of XSGD puts Singapore ahead of Hong Kong, where stablecoin licensing is not expected until next year. Across Asia, similar tokens have emerged, including KRWO, the South Korean won, THBX, the Thai baht, and JPYC, the Japanese yen, showcasing regional interest in national currency-linked crypto assets. Despite Singapore's cautious stance, requiring licenses for all crypto service providers and prohibiting mass market promotions, listing of XSGD on a major global exchange signals a pragmatic balance between innovation and oversight. Grab, Singapore's leading technology platform, has already integrated XSGD into its digital wallet for easier local and cross-border payments. Still, regulators remain wary. The Financial Action Task Force has warned that stablecoins could facilitate illicit money flows due to their peer-to-peer transferability. MAS reiterated that all stablecoin issuers and intermediaries must be licensed and comply with anti-money laundering measures. MAS said it is developing a framework to distinguish stablecoins from speculative cryptocurrencies, noting that well-regulated tokens, quote, can serve as a credible digital medium of exchange, end quote, and support more effective payment systems, an ambition XSGD's launch brings closer to reality. Next up, we move to Europe, but first, a very interesting company which I personally believe has the potential to be highly disruptive in a new emerging industry. Right now, gold is trading at an all-time high. We are entering a very volatile era where China, Russia, and their axis are finding ways to transact without the dollar, and the West is dealing with massive fiscal crises. This could be one of the most monumental and significant developments in gold and commodities we've ever seen. Everybody understands how Blockbuster's business model became truly obsolete and outdated when Netflix offered the exact same content but through streaming. ETFs made gold trading accessible to a much larger audience in the 2000s, in much the same way Blockbuster branches made movies accessible to cinema goers. But the next revolution that could make the ETFs of today obsolete might be here now. Billionaire mining tycoon Frank Gestra, along with mining legend Sean Rosen, are well aware of the opportunity in disrupting the current ETF providers with a fully backed, vaulted, audited, verified, yield-bearing financial product which could be accessible the world over, and Frank Gestra just invested heavily to the tune of owning 17 million shares of a brand new, just listed Nasdaq company called Streamex, the sponsor of today's video. Streamex is aiming to revolutionize the industry of owning precious metals and commodities in general by commercializing fully backed, vaulted, audited, and verified ownership of gold and other leading commodities. If successful, it could be revolutionary, and do to traditional ETFs what Netflix did to Blockbuster. Right now, Streamex is just lining up the last details before launching its first product, the fully backed, yield-bearing gold one. For years, people have complained that ETFs are not ideal for them, hard or impossible to trust because of the backing or the auditing of them, and sometimes because of the management fees and premiums. This is how Streamex is a potential game changer. The company has secured up to $1.1 billion in funding through a mix of equity, convertible debentures, and a line of credit led by Cantor Fitzgerald, the company that was run by Howard Lutnick, Secretary of Commerce in the US, and now managed by his sons. This funding will allow the company to draw upon and should purchase physical gold to back their products, as well as to likely add to their own balance sheet. Their vision is to launch several gold products and then to expand to silver and others. Commodities are ripe for a fintech revolution. For years, investors have been complaining that owning gold does not earn a yield, and now Streamex has pioneered a product that will produce yield. The proprietary platform Streamex developed attracted as their chief investment officer Mr. Michelle Williams, who not only ran the Kuwaiti Sovereign Wealth Fund, but is also one of the solo portfolio managers for Oppenheimer's flagship value fund. Put simply, this company is packed with world-leading specialists and industry titans. The platform itself was developed by the same software experts that built cybersecurity infrastructure for Capital One Bank, Bank of America, and JP Morgan's credit card processing infrastructure business, one of the largest fintech platforms in the world. Tokenization of real-world assets is the biggest and most important financial disruption of our times. Most are scrambling to upgrade their offerings to the chain. This is a potential Netflix versus Blockbuster moment many times over. Streamex seeks to be a fintech tokenization giant. Investment in such a revolutionary company is by its very nature a speculative move. High risk, but if successful, also high potential reward. Streamex seeks to disrupt the current giants in commodities ETFs with fully backed, audited, and verified ownership, redeemable and secured, and is worth doing research on. This sponsored feature is not individual investment advice. For more information on this company, including relevant disclosures, this is listed in the description below. A big thank you to Streamex for sponsoring this episode of Market Update. We now return to regular coverage. And finally for today, London's once dominant role in global finance has taken another hit, slipping out of the world's top 20 initial public offering IPO destinations for the first time in decades. The UK capital now ranks 23rd globally, behind even Oman, Mexico, and Singapore, marking its weakest IPO years since the late 1980s. Total deal volume on the London Stock Exchange has plunged 69% to just $248 million so far this year, while the third quarter alone saw a collapse of 85% from a year earlier, the largest new listing of 2025. An April float by accountancy firm MHA raised a modest £98 million, or $132 million, arranged not by Wall Street banks but by smaller brokers. The downturn reflects deep structural challenges in London's capital markets. Once a global powerhouse for listings, the city has steadily lost ground to rivals offering higher valuations and lighter regulation. In 2006, London IPOs raised $51 billion. This year's total represents a 99% decline. There is no pretty way to paint this. This is a collapse. The UK's share of European fundraising has also shrunk from more than 50% in 2013 to just 3% today. Quote, low valuations make it unattractive for private owners to list, while bargain hunters and private equity are snapping up undervalued public companies instead, end quote, said Leonard Keller of Berenberg. Major buyout firms including KKR, Bain Capital, and Blackstone have targeted London-listed firms, accelerating the market's contraction. Meanwhile, Singapore and Mexico, with $1.4 billion and $460 million in IPO proceeds respectively, have surged into the top 20 thanks to property and industrial listings. UK authorities are trying to reverse the slide with regulatory reforms, easing rules on dual-class shares and index inclusion. London Stock Exchange CEO Julia Hoggett has pledged to expand the junior AIM market and develop new trading venues for private company shares, but momentum remains elsewhere. Quote, larger firms increasingly see the US as the only place to achieve fair valuations, end quote, said James Cogden of Canaccord, adding, quote, for now, the message to global issuers seems clear. Avoid the UK, end quote. Okay, that is today's episode of Market Update. Thank you so much, everybody, for watching. I'm currently in Japan. I've had some very useful, very good conversations with some folks here, and I look forward to rolling out my thoughts on the current leadership change in Japan and its implications for the wider economy, and just where Japan is in terms of equities, in terms of its economy, in terms of its trading position in tomorrow's video. So I look forward to presenting that to you tomorrow. Thank you again for watching. Have a good Monday, have a productive week, and I hope to see you for the next episode tomorrow.